We're going to be looking at true opens, fair value gaps, breaker patterns, 90-minute cycle, intermediate term swing points, and protractions. I'm going to go to a random point. Yes. Random point in time. It's all done on a 5-minute chart. I'm not going to change the time frame. Let's just do 26th October. So that is midnight. It is midnight. $1800, 6 o'clock, 12 o'clock, and 1800 again. Oh, it isn't. Oh, it didn't look like much movement, but it is actually. Okay. That's enough to get along with. Okay. So Q1 is from 1800 to midnight. And then this is the true open, Q2. So we're going to be looking at from Q2, the true open. We're going to be dividing this into quarters. Darken this line, its boundaries. Half past 1, 3 o'clock, and 4:30. 1, make it 1. And Q1 we're looking for consolidation. Consolidation means either A, a small range, or B, a run on highs and lows. So this highs run out, makes a swing low, makes a new swing low, that swing low is run out, that swing high is now run out. So there's no obvious trend. That's what a consolidation is. And then Q2 we're looking for the highs of Q1 to get taken. So right there, that's not taken in Q2. See the dotted line. But the low is taken. So that low is taken. Okay. Now we're gonna mark Q2 the true open, and that's the true open for this session. So whatever you're doing, you want to buy below this true open and sell above. If price is below here, you're not allowed to sell. If price is above here, this line, you're not allowed to buy. And make that a bit darker. So the low is taken, price is below, true open, low is taken and swept, we have a fair value gap, and now order block. And now we are waiting for Q3, which is distribution. So we are looking at this. After this low is taken, we're looking inside Q3 for area from this first fair value gap after the low is taken all the way into Q3, Q4, as well as this order block. So this whole candle, we'll mark the high of this. Let's mark the whole candle actually up to this open. So those are areas of interest, but as you can see it's all above through open, so we would be ignoring this day for buys. It took the low, went up, didn't take liquidity on the highs, so we'd ignore this session, this 90-minute cycle, because price was mostly above through open and we couldn't buy that time. So next 90-minute cycle, don't get me wrong, there is trading opportunity to sell, but it's just much cleaner to be buying. We'll go 7:30 and 9 o'clock. Oops. 10:30 and 12 o'clock. Oh, make this darker. So now we've got Q1, Q2, got Q1. We're gonna mark up the highs, Q1. And the low of Q1. We're gonna mark out through open. So this low gets swept, Q1's low gets taken, pushes up, there's a fair value gap inside here, so that qualifies this now. From this low to this swing high, down to this swing low, it becomes a breaker. And we'll measure this from this low to here, 4 standard deviations, this low to this swing high. So we've got our stop, long position, we've got our stop below the low. Since liquidity was already taken, it shouldn't go back to that point. Stop below the swing low, targeting 4 standard deviations. The real target is 2, 2.5 and then 4, but 4 is the ultimate target. And now we're just looking for our entry. So we've got a fair value gap, it gets filled, and then if you guys have been watching ICT videos, there's this thing, it's market maker model. So it goes uh, key resistance or support or turning point. Price gets into a fair value gap and it makes a swing low, and then it goes through that swing low, and that's the point of buying. So you would try to buy inside of here, this red candle, the top of this candle. One to 1.8. Now look at the next 90-minute cycle. Make this one thicker. So 12, 130. Three and 430. I'm gonna mark out the high, the low, I see this low doesn't get swept, but the high does. So the high gets swept all the way up here. We've got, I don't know where this candle ends, let's just check quickly. So there's a small fair value gap inside here. And we've got a more obvious larger fair value gap in here. So this would be the new breaker. So it's this high, it took liquidity, and then you have a higher high. So you're only entering, most of your trades will be entered in Q2 or Q3. Like in the previous example, we entered in Q2, now we're entering in Q3. So you've got all these up candles. Okay, the swing. This would be breaker pattern, high, low, higher high, and then the breakdown. You can see this candle here be of more importance. So it would be your Q3 entry, overlapping this fair value gap. And the target would be two, 2.5, and 4 standard deviations. And I'm saying 3 targets because partials are important. let's say you entered where these two overlapped, right there, short position. Stop above the high. Two standard deviations. A 1-to-1 risk reward. And you would have gotten stopped out. Yeah, stopped out. This is Q1, we don't trade Q1. And by Q1 I mean Q1 of the 6-hour cycles. Let's do 6. Darker. This one darker. $1:30. 3 o'clock. Then 4:30. High gets taken first. So the high gets taken first. So we're looking at the first swing high before it's taken. Actually, no, we're looking at the highest high before it's taken. Down to an intermediate term swing low. And we're always moving right. So this one. This one is not an intermediate term swing low. This one is not. So we'll take the first swing low. If we use this one, go to standard deviation. Okay. So we've got this move up, taking liquidity, fair value gap. Stop, target 2.5 and 2. One to 1.5 or trade. as this being an order block. So now I'll mark out 7:30, 9 o'clock, 10:30, and midday. Mark out the high. The low. See the low is swept. We've got a fair value gap. Tiny fair value gap. Got a volume imbalance. We've got through open. So this low is taken. We're gonna from the swing it made the low up to an either intermediate term swing high, which is not found here before the swing was taken, or just a short term swing high, which is right here. Fibonacci, low up to the high. So looking at 2, 2.5, and 4 standard deviations. Buying below, so it will be inside here at 8:30. Stop below the low. We could even buy up inside the volume imbalance. Stop below the low of Q2, targeting 2 standard deviations, which would be 1 to 1.8, 2.5 standard deviations, which is 1 to 2.2, or ultimate target of 4 standard deviations, which is 1 to 3. That's with entering inside the volume imbalance instead of the small fair value gap. If you enter inside the small fair value gap, it will work by 1 to 6. Go back, let's go back, let's go back. So Wednesday. So 1, it would have been a loss. 2, 1.8, so up 0.8%. Another loss, down 0.2%. Get a win, so we're up 0.3%, 1.3%, and we get another win. So we're up 4%. 1, 2, 3, 4, 5 sessions in 2 days. Pretty good if you ask me. Okay, let's keep on looking. Midnight. Well, let's look at November month. Okay, starting the 3rd of November. One 1:30, 3 o'clock, and 4:30. So we got the high just here. High gets taken, then it gets taken again during Q2. No fair value gap. Okay, you've got our first fair value gap. Tiny one inside there. So it's only a liquidity raid or a run on stops when the high gets taken and there's a fair value gap that follows. So if a high gets taken and a fair value gap down, or a low gets taken and fair value gap up, that's how I qualify it. Now I've got this high down to this low. That would be our projection. So it's 1, 2, 2.5, and 4 standard deviation. We've got our fair value gap. We're either on stops with a fair value gap. Now looking for entry. Got through open. Now we're gonna mark up all areas of interest above through open. So we've got, okay, that there, takes it slow. So we've got an order block. Those 3 consecutive up close candles, order block. Order block, got our fair value gap inside here. Let's do it like this. Got our fair value gap, and we've got a volume imbalance. So you could enter in a fair value gap or this volume imbalance. I'll just take it as a volume imbalance entry. Short, stop above the high. Target is 4 standard deviations. Or 1 to 4 risk to reward. So you'll see the best entries are gonna be above true open and in Q3. A retracement into a PD array of Q2 that happens in Q3. So like this, for instance, taps it and just plummets. We had another example earlier. Let me go find it. Okay, this high gets taken. High gets taken, but as you see, no fair value gaps down. No fair value gaps down, and no other liquidity taken. So if we took this low here, I would then, with a fair value gap up, I would be looking for buys. But nothing spikes up, but nothing. Okay, now 1800. High gets taken, no fair value gap, no entry. As you can see, fair value gaps qualify other PD arrays. I think I'll stop here for today. Okay, we've got Monday, Tuesday, Wednesday, Monday. Oh, a whole week. A whole week that we didn't look at. Okay. Here's a crazy example. This one was kind of cherry picked. 6, 12. $7:30, 9 o'clock, 10:30. Lows get taken out. Now looking for qualifier, which is fair value gap. Right there, we've got a fair value gap. So this whole area now become one order block. All these down close candles that open up to the high sensitive. We have our entry at the open. Sorry, at the high. Stop below the low. Target would be swing low up to intermediate term swing high. So you see the short term swing high? I'd rather use this intermediate term swing high because it's much better. That I found is much better. So it's 2.5, 4 standard deviations. Now 4.4 risk to reward. Okay, next one. Go run on stops. No fair value gap. New run on stops. No fair value gap. Run on stops with fair value gap inside here. No entry. And it's okay. Sometimes you're gonna miss moves, sometimes you're gonna leave profit on the table. It's all part of the game. Next one, midnight 6. 1:30, 3, 4:30. Got consolidation, run on stops. Now waiting for fair value gap up. So here we get the fair value gap up. And the second one, taking external range liquidity, so it'll come back to internal range liquidity. So either this fair value gap or this one, as well as this order block inside here. And we've got tiny volume imbalance. Also, all of this is below through open. So it'd be this swing up to this high. Swing low, swing high. 2 standard deviation, 2.5 and 4. Stop below the low. Targeting 4 standard deviation. 1 to 2.7. Okay, that's it for today's video. I hope you guys found it insightful. If there's any more questions, please leave it down below in the comments. And remember, there's only 3 constants in life: death, taxes, and losing money trading. Have a good day. Cheers.